In the early 2000s, the world believed it had entered a new financial era. Inflation was low, growth was steady, and economists spoke confidently about stability. Banks were innovative, markets were sophisticated, and risk, it was said, had finally been tamed. But beneath this calm surface, the foundations of the global financial system were quietly rotting. At the center of it all was the American housing market. For decades, owning a home had been the core of the American dream. After the dot-com crash of 2000, interest rates were kept extremely low to stimulate the economy. Cheap money flooded the system, and banks began lending aggressively. Mortgages were no longer just loans, they became products. Risky borrowers were approved, standards were lowered, and debt was repackaged as opportunity. Banks bundled thousands of mortgages together and turned them into complex financial instruments known as mortgage-backed securities. These were sold around the world to pension funds, insurance companies, and governments. Rating agencies labeled them safe.
AAA. Almost risk-free.
Few people asked what would happen if homeowners stopped paying. As housing prices kept rising, the system appeared to work. Homeowners refinanced, banks collected fees, and investors earned steady returns. The belief took hold that housing prices could never fall nationwide. That assumption would prove catastrophic. By 2006, cracks began to appear. Interest rates rose.
Monthly payments increased.
Subprime borrowers, those with weak credit, started defaulting. At first, the losses seemed manageable. But the problem wasn't individual homeowners. It was the system built on their debt.
The true danger lay in leverage.
Major financial institutions were borrowing enormous sums to amplify profits. Some banks were leveraged more than 30-to-1. That meant a small decline in asset values could wipe them out entirely. And those assets, mortgage securities, were now losing value fast. No one knew who was exposed.
Trust evaporated.
Banks stopped lending to each other. What had once been a liquid, interconnected market began to freeze. In September 2008, the illusion finally collapsed. Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy. It was the largest financial failure in U.S. history. Overnight, markets around the world went into freefall. Stock indices plunged. Credit markets seized. Companies couldn't access cash. Even healthy businesses were suddenly at risk of collapse.
Fear spread faster than logic.
Money market funds broke the dollar.
Global trade slowed.
Airlines, manufacturers, and retailers all faced existential threats. What had started as a housing downturn in the United States had become a global financial crisis. Governments were forced to act. In the United States, the Federal Reserve slashed interest rates to near zero and began injecting trillions of dollars into the system. The Treasury launched massive bailouts, rescuing banks deemed too big to fail. In Europe, governments nationalized banks almost overnight. The goal was simple: stop the bleeding before the entire system collapsed. The public reaction was fury. Ordinary people lost jobs, homes, and savings, while the institutions that caused the crisis were rescued. Trust in banks, regulators, and political leaders was shattered. The idea that markets were self-correcting no longer felt believable. The global economy entered its deepest recession since the Great Depression. Millions were unemployed. Entire industries shrank. Years of growth were erased in months. Yet, from the wreckage, the system slowly stabilized. New regulations were introduced. Capital requirements were raised. Central banks became more powerful than ever before. But the fundamental lesson of 2008 remained uncomfortable and unresolved. The crisis revealed that modern finance had grown too complex, too interconnected, and too detached from reality. Risk had not been eliminated, it had been hidden. Distributed so widely that when it finally surfaced, no one could escape it. 2008 was not just a market crash. It was a moment of reckoning. A reminder that behind every abstract financial product lies something real: people, homes, jobs, and lives. And when confidence collapses, even the most advanced financial system in history can unravel in a matter of days.